Arman Financial Services to discuss the Q3FY25 financial performance and business update. Today, we have the senior management team of the company represented by Mr. Jayendra Patel, Vice Chairman and Managing Director, Mr. Alok Patel, Joint Managing Director, and Mr. Vivek Modi, Group CFO. I will now hand over the call to Mr. Alok Patel for his opening remarks, post which we can open the forum for question and answer. Over to you, Alok, sir.
Thank you so much, Shripal, and good evening, everybody. On behalf of Arman, I'd like to welcome all of you to our Q3 and 9-month ended fiscal 2025 earnings call. So joining me today is actually just Vivek, the Group Chief Financial Officer, and our Investor Relations team. I hope you had the opportunity to review the results, the press release, and the presentation, which are available on the stock exchanges and our website. So apologies, I don't think normally we provide at least 24 hours. This time, due to scheduling conflicts, there was a very short interval between publishing the results and the call. So anyway, I'll walk you through the results. So I would like to begin with an overview of the industry developments, highlighting the key trends in business, followed by a financial and operational performance of Arman. Over the past few quarters, the microfinance sector has faced several challenges, including over-leveraging, weakening of the center meeting discipline, deterioration of the joint liability group or JLG model, and rising employment attrition. Furthermore, the post-COVID euphoria experienced by microfinance institutions and in particular non-MFI lenders in the retail unsecured space, combined with a favorable regulatory environment, has significantly increased household indebtedness. This has occurred despite limited real income growth, placing considerable strain on borrowers' ability to meet their repayment obligation. As a result, we have witnessed high delinquencies and a corresponding rise in impairment cost across the industry for the past 2 quarters. These challenges have directly contributed to an uptick in the default rates, further exacerbating the financial stress within the sector. In response, both Arman and the broader industry have made concerted efforts to strengthen underwriting standards and mitigate risk of over-leveraging. Naturally, these measures have led to high rejection rates and, as a consequence, lower disbursements. Additionally, the increased focus on collection has also stretched the field bandwidth, further impacting sourcing efforts and contributing to staff attrition. This in turn has led to a decline in both disbursements and AUM. These evolving macroeconomic conditions have intensified pressure on microfinance institutions, making it necessary for us to strategically recalibrate our business models. The industry-wide AUM degrowth has also resulted in liquidity issues for the microfinance borrowers, and it is essential that these challenges stabilize before the cycle reaches a state of equilibrium. In response to the above highlighted challenges, Arman has taken a cautious approach by prioritizing portfolio quality and collections over growth. While this has resulted in lower disbursement and AUM contraction, we believe that this long-term strategy will strengthen our financial resilience in the long run. As on 31st December 2024, our consolidated assets under management stood at 2,280 crores, reflecting a year-on-year decline of 6.5%. Disbursement for the quarter amounted to 338 crores, while the 9-month disbursement stood at 1,170 crores, down 28% from the previous year, of course, due to the reasons mentioned previously. Our gross total income for the quarter was 164 crores, almost 165 crores, down 2.4% year-on-year, while for 9 months it grew by 10.9% to 530 crores. Pre-provisioning operating profit, or PPOP, stood at 69 crores for Q3, down 4.7% year-on-year, but grew by 13% to 231.6 crores for the 9-month period. Now, moving to the segmental performance. For the microfinance business, our wholly owned subsidiary, Namra Finance, reported an AUM of 1,768 crores as of December 31st, 2024, a decline of 13.6% year-on-year. Disbursements for Q3FY25 stood at 214 crores compared to 459 crores in the same quarter last year. The cautious lending approach along with aggressive provisioning has impacted short-term profitability, with Namra's Q3 profit after taxes at at a loss of 17.2 crores due to increased impairment cost of 67 crores this quarter. However, despite these headwinds, for Namra Finance, we continue to maintain a strong capital adequacy ratio of 45.7%. Our gross NPA for the microfinance business stood at 4.4%, while net NPA was only at 0.56%. MSME, two-wheeler and LAP, which is part of our standalone Arman entity, this business delivered an encouraging growth. AUM for this segment grew by 30.9% year-on-year to 512 crores. This segment's gross total income for Q3FY25 stood at 44.9 crores, growing at 32.4% year-on-year, while PAT increased to 9.9 crores, which is about 5.7%. As of 31st December 2024, capital adequacy for the standalone Arman entity stood at a healthy 39.45%. From an asset quality perspective, GNPA for MSME stood at 3.43% and for two-wheeler stood at 4.03%. Despite industry challenges, this segment remains resilient and continues to support the company's overall growth trajectory. The new loan against property or micro LAP segment introduced last year, although it is at a pilot stage right now, has gained encouraging traction. Presently, the product is offered in Gujarat and piloted in Telangana and MP. It's about 1% of the AUM so far. The focus of this product is on tier 3 and 4 and rural locations where we are expecting a good growth in the coming years. The average ticket size of LAP loans currently is about 4.5 lakhs. Now coming to the liquidity and borrowing, our liquidity position remains strong with cash and bank balances, liquid investments and undrawn CC limits amounting to 262 crores. Additionally, we have 120 crores in undrawn sanctions from existing lenders, ensuring continued financial flexibility. Total borrowing stood at 1,765 crores with a diversified funding mix. Of this, 34% was from banks, 11% from NBFCs and financial institutions, 20% from NCDs, and direct assignments or off-balance sheet liabilities contributed to about 30%. The rest is borrowed from DFIs such as NABARD and SIDBI and others. This mix reflects our ability to maintain funding access despite industry headwinds. On the collection efficiency side, collection efficiency for the month of December 2024 stood at 95.3%. The segment-wise collection efficiency for the 9 months FY25 stood as follows: microfinance 95.2, MSME 96.2, two-wheeler 95.7. Before we open the floor for questions and answers, I would like to take a moment to highlight some of the strategic initiatives that Arman has undertaken in response to the current challenges. We have reinforced our underwriting standards to ensure stronger asset quality and have expanded our collection team to improve borrower engagement and repayment discipline. Additionally, we have introduced a dedicated credit department at the branch level, which focuses exclusively on maintaining credit quality. In a sense, we have now completely separated credit from sales in microfinance. Encouragingly, early indicators from December and January show improving trends in the credit cycle, with zero DPD flow forward rates stabilizing. While it's little too early to tell whether we have reached the bottom, should these trends continue, we will adapt our business strategy accordingly. Although we have experienced a temporary slowdown in AUM growth, we remain confident in our ability to navigate these challenges in the industry and position Arman for long-term sustainable growth. Thank you very much, and now we can open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, you may press star and 1 to ask a question. Our first question comes from Apurva Singh from Pancharatna Investors. Please go ahead.
Hello.
Yeah, go ahead.
Yeah, am I audible?
Yes.
Yeah, good evening. Just wanted to understand what are the green shoots you are looking for to understand the cyclical turnaround, and what measures you have taken for recovery.
See, as far as green shoots are concerned, typically what we look at to judge whether we are coming out of it is zero DPD flow forward rates. This means people who were previously paying regular, who have become 1 day overdue at this point. So normally in the MFI segment, we would experience that at about 99%. So there would be 1% flow forward. Now, again, just because something has flowed forward, that doesn't mean it will get written off. Obviously, at every bucket there are repayments that happen. But we typically track flow forward rates quite closely at every bucket. Now, this will be too much details to get into, but until the zero DPD flow forward rates return to 99, I would not say okay, this is over or this is behind us. Now, that being said, we have seen, at least for the last 2 months, zero DPD flow forward rates have been 98% plus. So I think it was 98.03 in December and 98.15 in January. This month in February, zero DPD flow forward, again, I think till now we are about 35 to 40 bits ahead of previous month on a month to date. So again, I'm not superstitious, but in days like this, you become a little superstitious. So I don't want to jinx anything, but obviously there is minor improvements in the zero DPDs, in the last couple of months. Now, as far as the initiatives we've taken, I mean, there are many initiatives. Obviously, on a day-to-day basis, we work on all of them. Some of the larger ones is, people who follow microfinance will know that there was always a bit of a conflict of interest between credit and sales, where at the operational level, at the branch level, microfinance principle was that the guy who does the disbursement does the collection. And so while there was obviously a credit mechanism at the HO level and at the regional levels. It was not at the branch level. We have completely separated that now. So at least so far about 120 branches. By March we will reach most, if not all, branches. And the idea being is that if you cannot rely on JLG or JLG culture anymore, which again, it's too early to tell whether it's completely gone or if this is just a blip in an otherwise very successful model which we have been following. Arman has been following for 15 years, but the market has been following for, or the industry has been doing for better part of 5 decades almost, right? So, so that is one initiative. Another is that we have started with CGFMU. So that is, I don't know, Vivek, if you want to...
That kind of is the CGFMU is the guarantee cover being provided through the government's NCGTC, the National kind of Credit Guarantee Cover scheme. So that is available for microfinance borrowers. So we probably one of the few microfinance entities which have already enrolled, and as of Q3 disbursements, which let's say about 200 crores of disbursements that have taken place in Q3, have a guarantee cover through the CGFMU.
Yeah. So the guarantee is it's a little complicated, like all of these things get, but essentially what it covers is about 72% of your principal in default, ignoring time value of money. So let's say your default is 100 rupees, they will give you 72 rupees and 28 rupees the company has to eat it, for which we pay a premium. It's sort of a default insurance. And basically how the math works is that considering time value of money and all those other things, if your overall static pool losses at this point with what we are paying them crosses about 3.5%, you'll make money and or you'll come out ahead, and less than that. But again, let's not get into this is not a profit making. This is not a profit making venture or anything. It is to buy me better sleep, if that makes sense.
Got it. I think the focus is clearly visible. Thanks a lot.
No, and again, I'm sorry for the long-winded answer, but I'm sure something similar to these questions were there in probably most of the people's minds. So that's why I took my time on this question.
No, please, this is really helpful. Thank you.
Thank you. Next question comes from Shubham Jawar from Dexter Capital Advisors. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah, hi sir. Thanks for the opportunity. I had a couple of questions. The first one being, sir, on what DPT do we write off the loans?
So I think right now we are writing off quicker than, so the policy is...
The policy is anything which is not paid us for the last 6 months, once the account turns 180 plus. So essentially anything which is over and above, let's say 300 is automatically written off. But as of, right now, we are writing off anything which is not paid us after it has turned NPA, that is 90 DPD. So essentially anything which is 250 days or 240 days plus will get written off.
So basically, we are being slightly more conservative, and everything over about 250 days, if we see no hope of any recovery, is written off.
All right. And so basically also I wanted to understand, basically for customers who are flowing from DPT buckets, right? For example, DPT 30 to DPT 60 plus, what action do we try to take to stop that net forward flow?
So there are a lot of initiatives. So first of all, we have a RO mechanism, recovery officers, that now we have about 350 of those, and that will continue to increase. So those take over. At the FO level, we have various schemes. We are using bot calling. We are using auto calling. We are issuing legal notices.
There are Lok Adalat.
Lok Adalat that will be 90
180 plus.
Yeah, 90 or 180 plus. So everything that you under the sun that you can think of, we are doing.
Okay.
But again, I'm open to ideas. So if anybody has any clever ideas, I'm all ears. Anything to increase the collections.
Right. So
you have to be careful. You have to be careful with these customers. I mean, you cannot, you cannot use high pressure tactics because the kind of customers that you are dealing with, that is obviously not something that I would encourage.
All right. So my another question was, I wanted to understand more on over leveraging, right? So as I understand, the first guardrails had been announced somewhere in August of 2024, and the second guardrails were announced in November 2024, right? I wanted to understand, since before these guardrails were announced, what were our internal guidelines that we followed which ensured we weren't exposed to any, over leverage in the borrowers? Like, what were our internal guidelines before the first guardrails itself?
So we were using FOIR like everybody else. So
Okay.
this will require a bit of a history lesson. But prior to April 2022, there were hard-coded over-leveraging, rules that were issued by
You couldn't be the third lender whatsoever.
that you could. I think you could be the third lender
Fourth lender.
or something. No, so you no more than 2 MFIs or no more than 3 lenders. The 3-lender norm was by MFIN more than anything else. But again, this only applied to MFIs. Now, there was a time when MFIs were controlling 80-90% of the market. Today, we are probably controlling 40, at the most 40% of total household debt of the rurals. Obviously, MFIs, although our portfolio has increased, there are many players that are servicing a rural segment, right? Now, after April 2022, all of those in a deregulation by RBI, a lot of change, including removing those caps, and what cap they imposed was a 50% FOIR. So you assess them, and their installment should not be more than 50% of what they are earning, right? So all in all, that hindsight is 2020, but all in all, that seemed like a good measure, right? That you look at their household income and their income should not cross more than 50% of that. So largely, a lot of people were not looking at this +1, +2, +3 or anything. We had numerous underwriting standards which were in place. So first of all, we were looking at all loans, not just MFI loans, because MFI was losing ground in terms of market share. We were looking at husband-wife. We were looking at default rates. We were not even entertaining a customer who was one day overdue anywhere else. So there were various measures which were there. In hindsight, number of lenders is something that we found a close correlation. But let me tell you, even right now, 46% of our customers have an exposure of less than 50,000 rupees total. 68% of our customers have a total loan exposure, including all loans of less than 1 lakh rupees. Right? So I don't want to put over leveraging is the only problem here. I mean, there are a lot of, problems like this rarely occur due to one issue. I mean, there are always multiple issues. It's like the Swiss cheese model where it has to pass through a lot of holes to get here. I acknowledge % of the issue is definitely over leveraging, but there are many other issues. Debt has increased, aspirations have increased, culture has changed, JLG got diluted. And I'm willing to accept my share of the blame for whatever has happened. But I will not completely say that it is due to over leveraging or weak credit. There are many aspects here, and honestly, right now the biggest issue is that credit has stopped. Right? I mean,
Right.
credit has noodle. Disbursements are like half of what they used to be.
Mm-hmm.
When you stop liquidity, obviously things are going to get worse before they get better. So,
Right.
Anyway.
Yeah, so last two questions and then I'll again quickly join back the queue. The first was, is there any, what is the standardized process for income assessment both at the industry level and that we follow at Arman? And the second question was, what are our loan officers and collection agents? How are they incentivized? Incentivized is what I mean. These two questions.
So to answer your first question, we have completely revamped how we are assessing income. So, I mean, that will be...
When did we do that, sir?
So, I think we started the initiative in August, and so with the new BCM structure that I was mentioning earlier, earlier again that conflict of interest, right? The guy who was dispersing the money was assessing the income.
Correct.
And now today there's an independent person whose bonuses and everything depends on asset quality.
Mm-hmm.
So rejection rates are like 80-82% right now, right?
Right.
And that's not something to be proud of. I mean, it's very few lending businesses can run with that kind of rejection rate. So something or another has to change. But anyway, that's fine. Like I'm not too concerned about AUM declining. During demonetization, it had declined by a third during COVID. Once things are over, things catch up back very quickly. So that is not my concern. My concern right now is simply on asset quality, and 90% of our time goes towards that. Management bandwidth is stretched, field bandwidth is stretched on collections and repayments. So disbursements will come back to normal in due course of time. But that is not my priority at this point. Now, how are we incentivizing? See, field officer incentives, I mean, on average, they are like around 2,500 rupees. So that's a mix of lot of things. But nowadays, with attrition and everything, the way it is, and every month being different than others, we rely a lot on R&R kind of incentives. So we'll have certain zero DPD targets or collection targets and those things, or we'll have multiple contests. The actual incentives themselves have gone down significantly overall in exchange of base salary. And this is what, the field officers are demanding. And given the attrition, you kind of have to deal with that. Collection people, on the other hand, obviously their incentives matter on what buckets they are collecting. So harder the bucket, the more money they get. It's a standard system that pretty much everybody follows, including HDFC Bank and banks and NBFCs and whoever else.
Right. So my apologies, I couldn't understand the income assessment weight. Could you please elaborate that once again?
So the income assessment, lot of it is based on judgment. We'll try to get evidence as much as possible, depending on the kind of occupation that they are doing. So the simplest way to explaining is that if they are in a large part of our portfolio goes into cattle. So depending on the number of cattle they have, it's easy to guesstimate what kind of income they'll be having. Other occupations, it really depends on a case-to-case basis.
Largely, it's also dependent on a lot of self-declaration that the customer might...
Yeah, but nowadays we are not really paying much attention to the self-declaration.
That's wherein the BCM or the credit evaluation becomes more independent and assessment by the company.
Over and above that, there's also a lifestyle assessment that we do. So there are what kind of house they are living in comparison to people who are their neighbors, what kind of facilities do they have, do their children go to school, do they not go to school. So there's a whole form that is there. If you're interested, Vivek will walk you through it in a separate time, but unfortunately I don't think this is the right place to kind of walk through it right now.
Sure, sir. And sir, what is our loan write-off this quarter out of the total impairment?
It's about 45 crores.
45.
If you're talking of number alone.
Yeah. Number and total as well, the consolidated.
Total, I think I'll have to refer to the presentation, but we'll carry somewhere there.
Sorry, sir?
Carry somewhere in the presentation, but 25 in number and about 4 odd crores in Arman. So 45 plus for about 50 odd crores.
50 odd. Thanks, sir.
Thank you. Next question comes from Narendra from Robo Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. Am I audible?
Yes, please go ahead.
Yeah. So, sir, given in that we are in a position, give any growth or credit cost?
Sorry to interrupt, Narendra. Your voice is coming very low. If you are using speakerphone, maybe request to use handset or something, please.
Yeah.
Not only is it low, but it's cutting off, so I'm missing some of the words.
Is it better now, sir?
Yeah. Maybe. Go ahead.
Yeah. So my question was that given the situation that we are in currently, are we in a position to give out any guidances regarding AUM growth or credit cost for the next year?
Boss, I cannot even give you a guidance for next month. So I'm kind of joking, but the fact is that any guidance is meaningless at this point. We don't know how the next quarter is going to look like when the things. So until things stabilize, unfortunately, no, I'm not in a position to give any guidance.
Great, understandable. Yeah. Thank you so much, and all the best.
Yeah.
Thank you. Next question comes from the line of Moksh Ranka from Aurum Capital. Please go ahead.
I wanted to understand, since JLG model has suffered, so are we moving more towards secured mix? And will our AUM growth be mostly towards secured?
I'm sorry, are we moving more towards what did you say?
Mostly secured mix for LAP and two-wheelers, and MFI disbursements will be low.
No, so LAP is a long-term play. Just as we started MSME in 2018, about 5-6 years ago, and now it's 500 crore. We are not a kind of company that moves very quickly. We're sort of boring in that way. So LAP is a long-term play, and yes, you are right. We would like to get into a more secured kind of a book, but I don't think the secured book is going to be meaningful for at least 2-3 years. And secured is a whole another beast, really. If I open up a shop to give unsecured loans, it's very easy to sell those loans. If I open a shop to give secured loans, then it's not that easy. You gotta find customers who are willing to mortgage their house for their business and stuff. So it's a different business in many ways. And but I guess one way to answer your question, if I could, yes, definitely I would. But today I don't see it having a meaningful. Definitely we can target like a 5 to 10% over the coming 3-4 quarters. But to say the majority portfolio will be that is, I wish it was the case.
And microfinance is kind of here to stay. Yeah, we are through right now in middle of a bit of a crisis, if we can put it at a sector level.
Yeah.
But microfinance, it's not going out of package.
No, all you have to ask is there a need for this product? And I don't think 99 out of 100 people you ask is going to reply yes. So there is a need for unsecured small ticket loans in the rural segment. I was saying this to even people at RBI. I think I said it last time also, but I'll say it again. Since the 60s, Indian government, to their credit, has been trying to push the financial inclusion agenda, right? Starting from farm credit to PSU banks to PSL banks to cooperative banks to RRBs to bank linkage, NABARD, SHGs, MFIs, you name it. To their credit, they have done it all. Everybody has been so concerned to make sure that money reaches at the bottom that nobody was too concerned about too much reaching the bottom, right? So in many ways, if it helps you sleep better at night, this is a success, and it's a success of the financial inclusion agenda. At least the reach part. Now, all we have to worry about is how to assess them better and convince the customers to repay us better. Incomes, real incomes have not really increased since COVID. I think if you look at real incomes in the rural, they have increased by 0 to 1%. A lot of these guys, in hindsight, again, I've gone to the field myself, were supplementing inflation with loans, one way to put it. So I acknowledge that there were a lot of things broken, but the first step of solving a problem is, first of all, admitting there's a problem, and B, finding out what that problem is. And I think all of us, and I'm not just saying the company, I would say the industry at large, has grasped both of those things, has acknowledged that there is a problem, and now we are aware of what those problems also are. So give us some time, we'll fix them.
My second question would be don't you think MFI as a sector, our business model is quite fragile? Because if we look at generally, our cost of borrowing will be very high. On top of that, we need to carry a very high number of field force for collections, and because of that, our costs are going to be very high as compared to a fintech or maybe a bank. So don't you think our business, generally our business model as a whole industry is quite fragile?
Exactly 12 months ago, people were calling it very resilient. So I guess the flavor of the month will change every quarter. But I'm not exactly sure how to answer that. If you are comparing us to fintechs, let me tell you that is not the right comparison to make. Fintechs in operating in rural, unless they have a good method to collect the money, is a ticking time bomb according to me. But again, what the hell do I know? As far as banks, they've had a good 80 years to do it, and they have not managed. So if banks were in a better position to do what I do, then why haven't they? They've clearly had adequate time to do it. So again, I'm not exactly sure how to answer your question.
Okay, my last question would be what would be a cost of borrowing?
So marginally, I would say it's about 11.25. If you include everything else in it, cost
about, for quarter for the 9 months turning out to be about 12.86.
Yeah. So all in.
But the increment of the marginal cost, as Anil said, is under 12.
Yeah.
Okay, thank you. I'm wishing you all the best. Hope you have a good day. Yeah.
Thank you. Next question comes from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Hi, thank you so much for the opportunity. Am I audible?
Yes, thank you. Please go ahead.
So just wanted to understand from you that, say 4 to 6 quarters, the disbursements that we have originated, how have they performed on a cohort basis, quarterly cohort basis? So if you look at last 12 months.
Better, but in microfinance, first 6 months you don't really see a lot of defaults. So it's hard to judge at this point, but
no, because just trying to understand the momentum where we are at, right? Because
I understand. So if you are saying the stuff which we have, let's say, dispersed between April and April, May, June, right?
No, let's say 12. Let's take December 23 onwards, right? Because that will give a good runway for you.
I mean, obviously that will not look good.
Understood.
I mean, this was, I would say the peak of the bubble, if this is what it was Q4 of FY24.
Yeah. Understood.
So that's when the most amount of over leveraging would have taken place, and so after all said and done, if you do a static pool analysis, that will be the worst quarter, all considered.
And say the last, at least the last 9-10 months, the book that has been generated, they have been performing adequately in your.
Yeah. I mean, it's adequate is a word. I mean, it's nothing to write home about, to be honest. It's not,
I mean, largely what you want to compare it with. I mean, if I was to compare it with pre-COVID kind of a scenario, obviously these last 9 months performance may not kind of compare directly with the pre-COVID kind of a situation because the behavior of the customer has changed.
Right.
But is it performing? Then the rest of the book, at 1,800 crores of total AUM, 600 crores being the last 9 months or 6 months. Are these 600 doing better?
Yeah.
Obviously, they are doing much better.
See, what makes this current crisis that we are facing very different than what we have faced in the past is that in the past we could essentially buy ourselves out of whatever trouble, or the industry could rather buy themselves out by dispersing good quality customers which were plentifully available, right? So post-COVID, post-demon, we grew substantially. By the time you got into taking care of the bad customers, the good customers are replaced. In today's scenario, when the portfolio is falling, obviously the denominator effect works both ways, right? So that is why on a static pool today, my numbers will look better than what it is right now because the portfolio is declining. So again, everything is all relative. I understand. So let's not get into nuances of what ifs and what nots.
No, not getting into nuances, but just trying to ascertain where the momentum is heading, right? Because
no, I'm not talking to you. I'm not talking to myself. I'm sorry. So yes, the portfolio that we have created in the last 6 months looks much better than what we have otherwise, to answer your question simply. But it is not like pristine or anything like that, what we experience on a post-COVID.
Understood. And there's been a sharp increase in our 31 to 90 as well. It is specifically speaking about MFI. So it has gone up from 4.4 to 7.1. How to read?
4.4 was in March, I believe, and 7.1 is currently, right?
True. So how to read into this, and what will be the flow forward rate? Do you see that you can arrest this over here rather than it flowing deeper into our NPA buckets?
I mean, there isn't much to read from it. It's not like hieroglyphic. It's certainly not good. I mean, I have nothing good to say about it, except to say it is what it is. We are working on it. Flow forward rates, if it adds if it gives a little bit of comfort, are improving at every bucket. But yeah, I would say that we are watching those numbers very closely. All buckets we are watching very, very closely, and so we are trying to do everything that we can.
So, on a console basis, we've done a 175 crores of credit cost,
Yeah.
which 150 odd crores is number for the 9 months. How bad do you see this entire worsening of asset quality or higher write-offs being pushed to FY26, because we should start growing now, right? At least from this quarter onwards, or maybe from FY26, we should start having some growth. Not just growing, but even the base effect will kick in, right?
No, so I think disbursements will improve. We are seeing improvements in disbursements in Q4. So disbursements will improve. As far as growth goes, again, I don't think that will happen till Q1. What was your
And for the credit cost. So how should a person read that?
If your question is, are we pushing anything forward for FY26? The simple answer is no, absolutely not. So I think people who have known us in the past will attest that we have not done any top-offs, not done any restructuring, not done any net-off type things. And so far we have not done any ARC type transactions either, which is not to say that I'm about doing those, but we have not done it yet. So whatever needs to be taken care of has been taken care of.
Wait, so the reason I'm asking all these questions is, just to surmise quickly, is that on an average, an MFI loan is anywhere between 18 to 22 months. Some players also do 24 months. But on an average, industry is 22 months. Now, if we see when the crisis started, if we say that if we call FY24 as peak, so we are already 50% inside through the journey of that entire credit cycle being weakening, worsening. So now things have to start to give in, right?
If you say that the crisis started in April, we are 9 months into it. So by your logic, we still have about 15 months to go. 24 months ka loan giva to.
Okay, 24 months. ठीक है.
Right.
So that is a fair assessment to make.
We have to consider that the first quarter there were no real changes. I mean, people just started seeing an uptick in the
Q2.
People just started seeing uptick in repayments, right? And then there was heat waves and elections and stuff, which I openly said, this is India. It's always hot here. There's always an election somewhere. So anyway, I think we wasted the first quarter in just saying, okay, this is a temporary blip and it will recover. So really, I would say until August, nobody really took it seriously. Now, post-August, obviously everybody's kind of been, I don't want to say panicked or anything like that, but taking it very, very seriously. Including the industry and everybody. So, I think, I think my estimate gave 1 quarter ago remains the same, that we will see the bottom by March. Already I feel that we have probably reached the bottom, but I'm refraining myself from that conclusion because I don't have the data available with me to call it yet. And then from Q1, I would say you should start seeing an improvement. But improvement also to get back will take about a few quarters, right? So it's not like it's going to happen overnight.
Definitely. It's a lending business.
Aditya sir, may we request to return to the question?
Yeah, I'm done with my questions. Wishing the team all the very best.
And
Thank you.
thank you so much for taking out the time.
Thank you.
Thank you.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict yourselves to 2 questions each. If you have any follow-up questions, please rejoin the queue. The next question comes from the line of Nidesh Jain from Investec. Please go ahead.
Sir, can you share par 1 plus data for the microfinance book?
Par 1 plus data, Vivek, you have that? It's in the presentation.
Par 1 data may not be there in the presentation, but then you can go on the second question if you have, while we kind of pull that out.
So the second question is, what is your assessment of the stress in your book on the microfinance side? Given that there is a certain percentage of customers who are stressed, and once those are identified as GNPA or stress, then the X of that, the book should perform reasonably well, right? So what is the assessment of stress on the book and the microfinance side in your view?
I'm not sure I understand. You're not very clear. What is my opinion on the stress of the microfinance book? Is that what you're asking?
Yeah, so probably let's say 10% customers, 15% customers are stressed. Once those customers have recognized as par 1, then the rest of the book should start behaving reasonably well, right? So what is your assessment that this number is 10%, 15% in your view?
So I would say that, again, please don't quote me on this, although this is recorded. I would say about 20% of the customers are stressed in the industry. And why I say that 20% number is that 80% of my customers pay me on dot on the second that it is due, the money, right? So about 20% of customers will be late by an hour, 2 hours, 5 hours, 5 days, whatever, or don't pay me at all. So if I were to extrapolate, maybe 20% are under stress.
The par 1 to 30 you were referring to was about 3%.
3% of par 1 to 30.
Yeah. People who skipped one installment and
they're stable or later.
Okay.
That makes sense. So you have 2% zero DPD flow forward, and another one will be stable at 1. Yeah. Okay.
And so, in your assessment, with all these guardrails coming into force, industry becoming much more conservative, do you think this over-leveraging problem will be solved, or we expect further cycles, let's say 3 years down the line, 4 years down the line, because our industry will again go overboard and again overlend?
No, I don't think so. Believe it or not, I've experienced a lot of over-lending and over-leveraging in my career, including many bubbles. So, see, if it was only the MFIs who were controlling the industry, I would say, okay, no, it should not happen again. But, we are now controlling, NBFC MFIs are controlling 4 lakh, give or take 4 lakh crores of an industry which is 10 to 12 lakh crores. If you consider rural lending, right? I mean, you have 2.5 lakh crore SHGs, 1.5 lakh in retail to the customers, another 2.5 or so to the spouses. And again, these are estimates, so these are nothing, you won't find this hard data available on the net. So now it has, earlier on, every Tom, Dick and Harry was coming into rural lending because they thought it's high returns, high margin, even people who had nothing to do with lending money, the only way that could monetize their business was, through lending. A lot of technology companies and other ones, I'll refrain from using names or anything. Now all of that euphoria is gone, right? I mean, companies who had no business being in this industry post-COVID and post-deregulation came in droves. Now, I think MFIs never waste a good crisis. So I think we kind of pick ourselves up, make the adjustments, and move on with life. But until everybody else kind of sees that, I'm not exactly. I don't know. And maybe I'm being too pessimistic, but the fact is that Indians have a very short memory. Will everything will be done and dusted, and 2-3 years later, people will forget and life will go on. That's the way it should be. Really, life is too short to be dwelling on the bad days alone.
Sure, sir. That's it from my side. Thank you.
So again, to simply answer your question, I hope so. Go ahead. Next question, please.
Thank you. Next question comes from the line of Bhumin Shah from Samiksha Capital. Please go ahead.
Good evening. What has changed in last 2 or 3 months where so that flow rates are decreasing? So is it a structural change, or let's say due to the crop season, people are earning the money and paying back, and then again this issue may come up again?
No, nothing like that. We are just running out of stressed customers.
Okay, but there is a liquidity issue. So let's say borrowers who had 3-4 loans. So what is your assessment? Are they paying only one MFI, or are they letting go of two other 3 MFI because they are not getting any other money for the new loans, right?
Actually, an excellent question. And see, there's about 8% of cases that we have that people are paying us and not paying others, or vice versa. People are not paying us, paying others. But in my opinion, this thing about, I'm a bank, they'll pay me and they won't pay others, I mean, it's a myth. Practically speaking, it really does not happen. Most of the defaulters, and I would say 90% plus, if they stop paying one, they stop paying others. So that is number one. Number two, in our BI team, I mean, we look at a lot of data, and now that we have business intelligence also, we have noticed that whether you are, Arman plus 1, 2, 3, 4, 5, 6, whatever it may be, the lowest defaults are amongst the customers who have remained stable at the number of MFIs. So let me try to explain that better. What we have found is that, let's say, when I originate the loan, the fourth, right, which today, for some reason, everybody is tracking plus 1, 2, 3, 4. Honestly, I think people are paying too much attention to this. But anyway, I'll hold my thoughts to that. Let's say somebody that I lent money to that I thought was a good customer at origination, but I became the fourth lender. The lowest defaults are those that remained at 4. A person who was at 4 and became 3, default increases. Who was at 4 and became 2, it slightly increases more. And the reverse also, who was at 4 and became 5th, obviously in that case, the default rate skyrocket. But the lowest ones are the ones that remain stable with their outstanding and number of lenders. This is what is true in my portfolio. I don't know if it's true in others. And so you see, right? Like, I mean, only thing that you can kind of judge from that is to say that people who need money but don't get money also will become defaulters. So it works both.
Okay, thank you so much, and all the best.
Thank you. The next question comes from the line of Ronak Cheda from Avriga Capital. Please go ahead.
Hey, hi, Alok. Am I audible?
Yeah, please. Continue.
Yeah, Alok, I have 2 questions. One is on the CGFMU. You just mentioned that your rejection rates are upwards of 80-82%. Given that the industry has gone through a cleansing of your customers, or the industry per se, of whatever the rotten apples were, and then at a 80% rejection rate, how are you thinking of, going ahead and getting one more layer of security on the disbursements which we are doing, and at what cost? Because you're stepping up on your underwriting staff, you're stepping up on your collection staff, and now if you were to pay this premium, how does your economics work? If you could just highlight that.
No, so the CGFMU cost for us right now is about 1% a year for the principal outstanding of the customer, right?
So over a period of time,
let's say 2%. 2% will be the cost of that. So, but when I said 3.5%, that basically that calculation comes in because they're not covering 100%, they're covering 72%. And also there is some time value of money.
Because the first claim that you can really do is going to be almost 24 months from now, kind of a thing.
Right. Now that 2% kind of a cost theoretically can go up if your default rates are, so this is like the 1 year, and obviously depending on the default rate, they will reset it as time goes on. But that is what it is right now. So, but the first claim I don't think will come in till 2026.
Yeah.
So, so it's a long game. It's a long play. So I would not. But if I understood your question correctly, I think, are you asking me that am I being too conservative? Is that did I read your question correctly?
Yes, I understand when the first claim will come in. I'm just asking where your rejection rates have gone up. We've gone through 9 months of cleansing of the industry, and then we are adding one more layer of insurance. So just wanted to understand.
You're right. That is definitely possible that, I'm being too pessimistic and everything like that. So as I said in my speech also that we are happy to change our strategies, even consider them every month or every week if need be, or every day. So, but until I'm comfortable, I don't think this is not a casino. Like I can't take crazy bets. Theoretically, if CGFMU is insuring 72%, I should go nuts, right? Just start lending. But that's not. I don't think that's how it should work or can work.
No, got it. And my second question is on MSME. So your AUM last quarter was also around 400 odd crores, and this quarter is at 410. You did allude that management bandwidth is towards collection. But how should we think, because your GNP, etc., asset quality numbers are in line? What is happening here? Why are we not stepping up? Is there a concern in this segment also, which worries you?
So obviously MSME credit costs have gone up, and really you are just dealing with a different sub-segment of the same customers. They are cousin brothers only of MFIs, right? So it would be surprising if there was no impact. Then that would definitely mean that something is amiss overall. But there is just so much pressure in the market that you cannot push disbursements right now. So whatever is happening naturally is happening. Rest of the time we are concentrating on quality. So we're not pushing anything. Let this year end. There's about a month and a half to go. This year has been a wash. I don't think it's probably one of the worst years of my career, to be honest. But let this year get over. Come April, we'll take a rethink and restock of things, including policies on MSME and everything, and whether we want to push growth or not push growth or whatever it is. So I don't think that we are going to achieve much in the next month and a half, even if we change our strategies right now.
Got it. Thank you so much and best of luck.
Thank you. The next question.
We'll take a few more questions.
Sure.
Yeah.
The next question comes from the line of Srinath V from Bellwether Capital. Please go ahead.
Hi, Alok. Just wanted to find out how's the experience been in the MSME business. Would it be possible to share X bucket, zero DPD? How has been the credit experience when you're balancing growth as well as collections in this particular product? Because I remember both were being handled by the same person.
Yeah. So last month was 98.8% was zero DPD. So not quite 99 plus, but better than MFI for sure. And I think NPAs and stuff look similar, but you have to understand that you cannot just look at NPA. You have to look at NPA along with the impairment cost and provisions and everything. So whatever is written off is not going to come in NPA. So by that respect, as Vivek said, in MFI we have written off about 45, while in MSME we have written off 5 or 7 crores maybe. I think Vivek, if you want to share MSME specific numbers, happy to share it. But
generally, Srinath, in terms of the PAR numbers that we were discussing earlier on some of the questions and also in the presentation, the PAR 31 to 90 is about 1.9%, so under 2%. And the NPA for MSME is about close to 3.5%. So overall, comparatively, the stress is lower. If you compare it with what it was last year, obviously it has a 2.2 NPA has grown to about 3.4 already, and there have been much bigger write-offs that we've seen in MSME and Arman standalone. So that's where the stress in the unsecured can be felt in the Arman book as well. But on a kind of apple-to-apple comparison, the overall stringent credit process that we followed over the years is, kind of giving better returns.
Got it. And given that that product has had a little better credit experience, are we looking to what is the growth plan here from a branch growth perspective, team addition? Because disbursements growth has kind of flattened out quarter on quarter. So are we looking to take this to 100 crore disbursement somewhere mid next year or something like that? Just want to get a broader understanding, Alok.
No, so we have grown by about 30% on a same quarter previous year to now. But in the past couple of quarters it has flattened, specifically due to the microfinance stress. So obviously that has led to larger rejections.
Rejection would automatically be felt here as well, because if let's say there is an overlap customer who is defaulted on microfinance loan or
some other place,
the impact is going to be felt here in terms of the microfinance player.
Yeah. So we are definitely not where we should be, even in MSME. But I think, honestly, I would have expected a sort of a disbursement run rate at this point of being at least around 50 to 60 crores. But clearly we are not there yet. We are at more around 40 crores or so. So let's say by first or second quarter we can reach somewhere in the neighborhood of 60 odd crores of disbursement.
This is per month, right?
Sorry?
This is 60 crore per month or per quarter?
Per month. Per month.
Got it.
We are not opening branches. We got to keep the OPEX down. Obviously OPEX has gone up in an effort for this collection. Income is going down. So everything is out of whack. I cannot afford, the P&L and my balance sheet cannot afford right now me going crazy and opening branches, and it's just as I said, management bandwidth is also stretched trying to deal with these issues. So I understand MSME is doing better than micro, but there is no there's no compound wall also sometimes. I mean, whatever problems MFI is facing, some of it will creep into MSME as well.
Got it. So at least it's fair enough to assume that on the way out, probably sometime mid next year, this would be one of the first businesses to start growing, right? Meaning like where you go to like 60 crore a month, so on and so forth. Just fair understanding, right?
Yes, I agree. See, right now it's very difficult for me to put pressure on anybody to disperse money. Let me be very frank with you. I cannot go to my business head and be like, disperse, targets, this and that. Whatever is naturally happening is happening. But yes, I call him 3 times a day about collections, that's for sure.
Got it. And last question is on LAP. How is the pilot in Madhya Pradesh, Telangana? What has been the broad feedback? Again, what is our branch growth? How many branches are we in Gujarat, outside Gujarat? What is your broad thinking on, putting up new branches? And if there was a kind of file per branch kind of vague number in your mind, is that also going to improve, or largely are we looking at growth from just a branch perspective, moving away from the slightly more sadder topics to something more interesting?
Yeah. So thank you. So overall in MP and Telangana, it's too early. So we have just hired our team yet. Telangana, have we dispersed anything in Telangana? Very few files overall in micro lab. I think you'll get a better idea. So we had not dispersed till Q3. I know that.
Q3 we've not.
January and stuff we have started dispersing. We just hired a new guy who has some experience in secured and lap loans also. So right now we are dispersing out of 15 branches, if I'm not mistaken. And we'll probably expand that to at least 25 branches by next year.
So we've kind of people and set up there to about 19 odd branches as of December.
Got it. And how do you see 12 months out from what are your broad plans on branch rollout and, the team setting up and broader architecture or thought in your mind for that business?
For the micro lab side?
Yes, LAP, yeah.
As I said, so we have reached a run rate of around 3 crores a month. The target was to reach around 5 crores by year end. Obviously, that did not happen. But overall, the good part about micro lab is that it does not run down very quickly, right? Because the tenures are longer.
Correct.
So while the disbursement run rate, I don't expect it to cross, 5-7 crores in the coming 3-4 quarters. But the portfolio will increase faster than monthly disbursement run rates, because it's longer tenure obviously.
Perfect.
The owner plan is there. So we have a lab guy there. We have hired people in Telangana, MP. Gujarat is obviously there. But I think, as discussing with others also, that probably Gujarat is not the best market for this product. Telangana will be slightly, southern markets are more favorable for this products. MP, again, there is good feedback we are getting for this product as well. But this might not be a product for all states, because again, the paperwork and all of those things are very important. So while you might find customers who are interested, whether these are mortgageable properties, at least to a reasonable extent. I know that we are not going to get like 100% executable mortgage or whatever you call it, but as long as we can get it to a point where we're comfortable, I'm okay to do it. But a lot of places in rural and in tier 4 cities will not be there. The paperwork is just not there.
Cool. Thanks a lot, guys. I'll get back into the question queue.
Thank you. The next question comes from Anant Mundra from My Temple Capital. Please go ahead.
Hello. Thank you for the opportunity, sir. So what is the provision cover that we carry on our stage 2 bucket in Namra?
Can you move on to the second question or just pull out the figure?
Sure. So
this is cover on stage 2 bucket. So that is 30 to 90 bucket.
Yes.
Yeah.
So what I'm trying to basically understand is our current book has reached 98.1, 98.2 kind of a X bucket collection efficiency. So do we at least make a break even on the current book, and whatever credit cost that has to accrue in future is only mainly going to come from the bucket that has already, like the current stage 2 bucket? That's what I'm just trying to understand. And is that understanding it? Like, do we at least make a break even at 98.1, 98.2 current bucket efficiency?
Yeah. So, I mean, ballpark, you can make your calculations, but I cannot comment on this. But what is
the provision cover of Google is about 42% on the stage 2 cases.
All right. Good.
Okay.
That's the ECL. That's the ECL.
ECL. Okay. Accepted credit loss.
Okay. So any comments on, do we make a break even at least on the current book at a 98.2% kind of a collection efficiency?
Frankly, I don't know. I can do the math, but I'm not sure at this point. So Vivek,
I'm not too sure whether I got the question right.
He's saying, I mean, a lot depends on flow forward rates of other buckets, but he's asking at 98.2%, are we at a break-even stage? See, there are too many wheels. There is OPEX, there is credit cost, there is, lending cost, borrowing cost, and there is also interest income and many factors.
So again, just to kind of keep it to your question only specifically, 98.2, let's say, is one part of the entire bucket. This probably might account for 95% of the revenue for me, but then the balance side is equally important. So the flow forwards, when we talk of the current bucket, it probably has the largest impact. But flow forwards at all the buckets are equally important. If I've written off, let's say, 100 crores in last 4 quarters, it doesn't mean that I've forgotten about them. Collection, even if let's say 3% collection has to happen for them, that's revenue for me.
Nobody in two-wheeler, it's like 20-25% zero DPD bucket, right? But you collect it by the month end. So,
but if current bucket collection, as Alok said earlier, also if it kind of is 99%. That's good. That's given the situation, that's probably the best thing to have.
Yeah, that's probably it's it's like if you are going to a temple and asking and praying for something, like, don't ask for a private jet, ask for something reasonable. So 99, is it amazing? Probably not, but I'll take it at this point. I can manage easily with that.
Got it. And so just I missed out, how much are we paying as premium on the CGFMU insurance that we are availing?
1% a year.
1% a year. Got it. Okay, sir. That's it from mine. Thank you.
Plus GST. So I guess 1.2%.
Yes.
Thank you.
Got it.
Ladies and gentlemen, we would take that as a last question for today. I now hand the conference over to Mr. Shripal Doshi for closing comments.
Thank you everyone for being part of the call, and special thanks to the management of the company for giving us the opportunity to host this call. Thank you, sir, and have a good weekend, everyone.
Thank you.
Thank you, everyone. Thank you.
Thank you. On behalf of Equirus Securities, that concludes this conference. Thank you for joining us. You may now disconnect your lines.